George of the jungle, strong as he can be.
Who do you know that wants to be a landlord? That's what we're going to be discussing in thecreditjungle.com today. This is George Anderson. Thanks for coming in. And for a lot of people, the easiest way to acquire your first rental property is to not actually go and purchase a home as an investment property because it requires a much larger down payment, has to be a conventional loan, higher credit scores, and a lot of other things. So one of the easier ways to do that is to take the home that you are currently living in and then say, okay, let's go buy a new home and then keep this one as a rental. So this is what is called a proposed rental underwriting scenario. And we're going to discuss how the underwriting guidelines look at this. And for this part, this is going to be part 1, 2, and 3 of this. Part 1, we're going to assume that the underlying loan on your house is a conventional loan. And you're going to notice here that this house, on the diagram at least, is bigger than this house. So if you already live in a very nice home and everything like that, don't try to tell an underwriter that you're going to rent out your $500,000 home to somebody else and go move into a smaller house, especially if you have a family and some kids and everything else. It's got to make sense. It's got to pass the smell test. So that's why this house over here is a bigger home than this one, because the one you're going to move into is going to be a nicer one. But whatever your payment is here, the underwriting guidelines that I'm showing here are each going to treat what this amount of rental income coming in off of this. Obviously, you wouldn't rent it out unless you thought you could rent the house for more money than what your payment is. But how that gets treated on your debt to income ratios is different based on what type of loan this house is going to be financed on. So if you are trying to go into this house and get a USDA or a rural housing loan, the answer is here you just can't do it. You can only have one home financed at a time, period. So regardless of what type of loan you have here, if you want to go USDA here, you could do that, but you're going to have to sell this one. Can't keep it as a rental property. FHA, it's possible, a little bit more restrictive. You've got to be able to move 100 miles away, and it has to be for employment-related purposes. And then what FHA will do on that is they will allow you to count basically 75% of the rent here against the mortgage payment. And I'm going to go into the math on this in just a little bit. Fannie Mae says that, yeah, you could go ahead and you can go from this house into this house. Under all of these circumstances, they're going to want to see that you've lived in this home for a year. Because they're saying, well, maybe your intent wasn't really to live in this home. If you bought it a month ago and now you're going to move out and go and buy another one, maybe you didn't really intend to live in this one to begin with. So you want to pass the smell test on this again. I've got another video on this that you want to be here about 1 year. Then you got to look at some capital gains considerations, because if this house is rented for more than 3 years and you guys have lived in this one for less than 1, when you ultimately sell this house, you might have a very nice capital gains appreciation, but you're going to get hit with the capital gains tax on that one. But anyway, so Fannie Mae says, yeah, that's fine. And we're going to count 75% of the proposed rent here. And then Freddie Mac, Federal Home Loan Mortgage Corporation, and the Veterans Administration have basically the same guidelines. And what they do is they allow you to basically I'm just going to put here the term wash. They allow you to basically wash whatever that payment is there. So in other words, you can't count any more income from it. So let's go look at some numbers here and just kind of figure out what that is. So let's just say that the house payment on this home right here, let's just say that it is $1,200 per month. And let's say that the rents would be $2,000 per month if you could rent it out. That's a pretty good cash flow for a rental property, and it would make sense if you're in a situation like that. Who gets to determine what the rent is? Do you just have a lease agreement or some other stuff on that? Well, for the most part, yes, you do. Now, when you're purchasing a home, it's a little bit different if you're buying a rental property on how those rents are calculated. But let's just say that fair market value, and you were able to get a lease on it, and the lease here can either be month to month, or it can be a 12-month lease. Here they're looking for 12-month lease. Here it can be month to month on this. But either way, you've got a lease agreement, and the lease here, let's just say, I'm doing this for easy math's sake, that you would be able to get $2,000 a month, okay? Well, 75% of $2,000 is $1,500. So you'd have $1,500 a month of what would be net rental income. The reason they put a factor in there is because they know that you're not 100% of what you collect isn't going to be profit. You're going to have maintenance, you're going to have repairs, and you're going to have vacancies. You may have somebody sign a lease for 12 months, but maybe they move out and it takes you 2 months to get another tenant in there. So you didn't collect rent for the full 12 months, you only got it for 10. So that's why they use a factor on that to be able to do that. But anyway, on this one, when we take out that 75%, $1,500, so we've got a net here of $300 a month of actual income. So you can use that rental income there only on this one. So there's $300 worth of rental income that you can use there to be able to count towards the next house. Now, I've actually got a client that has a house here and he rents out his basement. Now he's going to also rent out his basement plus his upstairs when he moves out of that. Can you count 75% of both leases? The answer, yes, you can. Okay. Now, if it's a duplex, it's real easy. But again, we've talked about this with accessory dwelling units, mother-in-law apartments, and everything else. I've got other videos on this, so I don't want to cloud you too much on here. But anyway, regardless of what the difference is here, if it's only $100 more, if it's break even, if it's double what your mortgage payment is, Freddie Mac and VA say that all you can do is count the rent here against the payment, and it's basically it's a wash. In other words, you're not being hit with the debt. You're also not getting the benefit of having some additional income to count on there. And then FHA is going to be the same thing on that one. FHA is going to be, they would count the $300 a month here. Okay. That's if you're doing correct. FHA if you're getting an FHA on the new one. So anyway, that is how this formula works out here. If the home that you are vacating and proposing to create this as your first rental property, this is how the underwriting guidelines are going to look at your debt to income ratios and how they would be treated when purchasing the new home. So hope that makes sense. This is George Anderson. Thanks for coming into the creditjungle.com today. Remember, you can push button, get mortgage professional. And I'd love to talk with you about your options and the best way to get the financing that you deserve. Have a great day.